The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Live from Studio 2 at Bloomberg headquarters in New York, I'm Alex Steele.
And I'm Scarlet Fu. We're kicking off to the closing bell here in the U.S., and we've resumed declines.
Tough day for the equity market if you are long. Let's take a look at where we're seeing the biggest breakdown. That comes with tech. The NASDAQ off by about 1.5%, slightly off the lows of the session, but it's still pretty ugly, led lower by Mag 7. S&P also still off by a full 1 percentage point, again off the lows of the session. What do you do? Where do you go in safety? Maybe you go ahead and buy the VIX. The VIX a little bit elevated, and gold continuing to hold on to that record rally, up $35 per ounce, well over that $3,000 level. Scarlett, definitely that risk-off tone today.
Yep, you speak of risk-off. Stocks are resuming their sell-off after a two-day reprieve as the U.S. exceptionalism narrative fades. And you see this in Bank of America's latest investor survey, which shows allocation in U.S. equities falling by the most on record. Just a month ago, the S&P 500 and NASDAQ were scaling new heights on hopes President Trump's policies would stoke growth, but tariff uncertainty has since taken center stage.
The tariff rate, Matt, in the coming year will be around 13% in our model. Previously, we had assumed around 3%. So those are really the three building blocks: the slower earnings growth, largely driven by slower economic activity and a higher tariff rate, and then a slightly lower PE multiple ascribed to the year-end growth for next year.
And the growthiest part of the market is under the most selling pressure today and all this year. Mag 7 names are in a bear market and stuck at 6-month lows with no relief, even after Jensen Huang's comments at NVIDIA's developer conference. In the past, his comments have lifted that stock price. M&A not helping either, with Google down despite announcing its biggest purchase ever, a $32 billion all-cash bid for cloud security startup Wiz. Now, normally, investors would look to soothing words from the Fed, which kicked off its two-day policy meeting, culminating in its rate decision in about 23 hours from now. But Jay Powell and company will be hard-pressed to offer any reassurances when they, too, have no idea what will happen with tariffs and the extent that slows down growth when inflation is still very much an issue. Alex?
Yes, Scarlett, and that inflation issue might be crystallized come April 2nd, which is when we get those reciprocal tariffs. So bear with me on the chart. I know the colors don't look great, but stay with me for a second. This is the VIX curve. So VIX function CCRV. This is the current curve right now. So this is where we are right now in spot, and this is where the curve pans out over the next couple months. Now, this is where we were just a month ago. Look at how much the VIX curve has re-rated on a spot level, but also come April and May of 2025, a huge jump in the expectations for the VIX. What that says is that potentially April 2nd will be that deciding factor. So what will kind of lead the market and what will move the market until we get to that pivotal date? Or are you just going to have to kind of batten down the hatches, Scarlett, and wait till we get past that reciprocal tariff date and then able to game out how to plan for that portfolio?
Yeah, all good questions. And of course, April 2nd comes in just about 2 weeks from now. So let's kick things off with Winnie Cisar. She is Global Head of Strategy with Creditsights. And Winnie, talk about April 2nd and what that means from the credit markets point of view, because credit tends to lead all the other risky assets. What are you seeing in credit markets in terms of positioning before April 2nd?
So I would say in terms of positioning, people are maybe concerned about April 2nd, but not panicked. And, you know, maybe 3 times the charm. We've already had this fire drill a couple of times this year. Is April 2nd really the big one? I don't know. I don't really understand how we're supposed to kind of ascertain what the reality of policy certainty is going to be. But people are definitely starting to pay attention because while we have this policy uncertainty, we also have economic indicators that have definitely started to soften, which I think is really what credit investors are paying more attention to.
When you talk about indicators that show the economy is starting to soften, can you characterize that a little bit more? Because you look at ISM manufacturing and you could see signs of stagflation. I know that manufacturing is not the lion's share of this economy, but maybe it's an indicator.
Yeah, so I think that stagflation light is how we have been characterizing our expectations for this year. Pricing pressure is not coming down. We're not seeing this immaculate disinflation. If anything, we're seeing some incremental pricing pressure because of tariff and policy uncertainty, and also just things that needed more time to kind of recalibrate themselves after the COVID and supply shocks and all of these things that have happened. While at the same time, the consumer momentum has definitely slowed down. Now, whether that was going to slow down with or without tariffs is a really hard question. We think it probably would have started to slow down just because inflation has been such a significant headwind to a lot of consumer spending.
So The result of all of this has been money moving out of the U.S. and into Europe, right? Particularly with the uncertainty. It's been most pronounced in European equities. Do you expect, though, that flow to continue? And does that bleed through into, say, U.S. credit, Treasury market? And what's the implication?
Yeah, so I would say right now what we're expecting is marginal dollars to invest, probably not going into the U.S. right now. The reality is the rest of the world is long the U.S. That's just kind of the reality of how markets operate. We're the biggest, we're the most liquid in the U.S. But there's a lot less policy certainty here than there is in Germany at this point. And so people are thinking, okay, if U.S. exceptionalism has to be reconsidered, then we need to align ourselves where valuations still offer you a little bit something, and also we have some incremental policy certainty.
But you're not seeing any selling to then buy? You're just seeing the marginal dollar go?
We have definitely seen some choppy flows for the U.S., especially on the retail side of things. We had a few weeks of mutual fund outflows from the investment grade market, which is always something you need to pay attention to, because that kind of marks a sea change in terms of how people are thinking about the market and where to invest. But we haven't seen a flee, right? Spreads are very tight still in U.S. corporate credit. If you consider the type of economic data that we've seen this year, which has definitely been underwhelming on the consumer side of things, and then just that, kind of blip of a jobs report last early August, credit spreads blew out much more than they have now. And so that tells me that people are not necessarily totally running for cover and fleeing the U.S. side of things.
You mentioned spreads are very tight, especially in investment grade. I'm wondering what kind of relationship or correlation there should be between high yield credit and small caps. Small caps are down about 16% since November 25th. Is the stock market overreacting, or are credit investors getting complacent or have been complacent?
Yeah, so I think that credit investors are not necessarily complacent, but they've been quite okay to kind of hang out and say, balance sheets are in good shape. There's been no need to re-leverage. We haven't seen management teams doing, really crazy things and spin-offs and, re-leveraging share buybacks and all of these things. But at the same time, we have great yields, right? High yield at 7.5% historically is a good trade. Now, in the near term, we do think that there could be incremental spread volatility because some risk premia probably needs to be added into the equation as people were really bulled up on all of these positive deregulatory forces and animal spirits. And these things might still manifest, just not today, and probably not before April 2nd, and even maybe not before, the end of this year.
Yeah, lots of question marks on that front. There seems to still be a lot of issuance, though. I believe this morning there are 10 issuers lining up to sell deals on Tuesday. A lot of supply coming to market, certainly before the FOMC decision, but maybe, as you said, before April 2nd as well. Is there enough demand to absorb all this supply?
So far, yes. When we look at how deals are being absorbed, it's been fine. Maybe not as great as last year when there is just insatiable demand, especially for investment grade paper. And I think right now people are kind of looking at the yield environment and saying, things may go up, they may go down. Like, I might have another opportunity to buy an IG new issue at 5.5%. Last year, probably people weren't really thinking that was the case. Instead, they were thinking, maybe 4.5% is the next stop. So I think that there's a lot of investors who are being a little bit more critical with how and when they allocate their capital to the primary market, but it's definitely not been a buyer's strike.
All right, Winnie Cisar, Global Head of Strategy with Creditsights. Thank you so much.
Thank you.
We've got a lot more coming up on the program. Coming up, analysts in the snack space are warning of increased macro pressures in that sector. All eyes on General Mills. Results coming out tomorrow. We're going to speak with one of those analysts about whether the food giant can post results that'll make investors cuckoo for Cocoa Puffs.
Very nice. Very, very nice.
And
You didn't write that, did you?
No, no.
A deeper look into the tech as the tech wrap deepens with one of the biggest investors in this space. We're going to talk to Tesla with Ross Gerber, co-founder and president and CEO of Gerber Kawasaki Wealth and Investment Management.
And by this time tomorrow, Alex, we're going to have a clearer vision of the Fed's path forward. We're going to break down what to expect from Chair Powell with Betsey Stevenson. She is professor of public policy and economics at the University of Michigan's Ford School. All that and more coming up in the next 2 hours. This is The Close on Bloomberg.
NVIDIA stock not having a lot of support despite the fact that CEO Jensen Huang took to the stage today at the company's GPU technology conference where he announced their next chip upgrade is 1 year out. Those shares are still trading down over 2%. Here to discuss is Bloomberg Technology's Caroline Hyde. I'm not going to lie to you, when I look at the headlines, I do not understand what any of them actually mean. So filter the noise. What's the top takeaway?
Top takeaway is Jensen Huang can't rally the crowd or rally his stock right now, even though he's got a whole host of announcements for you. Whether it's still trying to convince you that the next scaling law is reasoning models, and the fact that these models go off, think about it for a while, come back with more complex ability to return your tasks, ultimately saying, look, this is what the Blackwell Ultra is going to be amazing for. The next iteration on Grace Blackwell is it Ultra that comes out in the second half of the year. But don't even think about that, because we've got the Vera Rubin for you, which is going to come out in 2026, named after another key scientist, which is all about space. We're thinking about 2027 rollout for that particular 3x the compute power type of chipset. But there's also a quantum chip for you. There's also the first ever foundational model for physical AI, for robotics. He's talking about deals with GM and the fact that they're going to have automotive focus there, as well as also manufacturing for them. There is a little bit of something for everyone, yet still the stock is down 2.6%. And people are kind of past the hype factor here, I think.
Okay, I think you summarized it really well by just saying people are past the hype factor. When it comes down to it, what did investors want to hear?
I think many had front run this. Many expected, okay, what's next? What's 2026? What's 2027? He's already got us in this mindset that they're rather like Apple. Every year there's going to be a new set of chips. Every year there's going to be another set of innovation. But what he really needs to convince people of is the fact that as these models get ever more efficient with fewer and fewer chips, just think of what happened with Cohere, that this week or the end of last week, both Google and Cohere released new models that are trained on just one H100 chip, or maybe two. But we're not needing this sort of compute power. You then, though, juggle that with what Bloomberg Intelligence put out. The fact that they see compute only going up and to the right. The demand for these very powerful chips is here to stay. And just think about what the Stargate announcement is of today. We understand from Oracle that they're busy, and the first set of manufacturing that's being built out in Texas is going to have 40,000 of these chips. That is a phenomenal amount of demand coming for GPUs for NVIDIA and Jensen Huang. I don't see compute demand going anywhere, but the market has started to basically cool off, and it's going to take a lot to turn it around.
Well, also, when you have these really tight supply cycles and chip cycles, too, like if you have a new chip every year, does that cannibalize what people just bought? Is it also really hard to ramp up, which then you have the margin issue, which is what we saw in the last couple quarters, too. So it's hard.
And Jensen sort of laughed about that when he was speaking in front of his fan base. I mean, this is like Mecca. This is like Woodstock. This is like the AI Super Bowl. Everyone's out there in California celebrating GTC. And he's actually saying, my salespeople are going to hate this, but why on earth are you going to need a Grace Hopper at the moment? Look at what my Blackwell is doing for you. And he's like, my salespeople are going mad. I promise. Ultimately, he's cannibalizing himself on the past iterations. So I'm sure that that's something that the investor base really need to get their head around as well.
Absolutely. All right, Caroline Hyde, thank you so much for making sense of all of that. NVIDIA, of course, holding its developers conference this week. And of course, Caroline Hyde giving us the roundup there.
Fix.
Yes.
Not 40,000, 400,000 NVIDIA chips in the Stargate.
There you go.
Texas
oh my gosh.
plant. Sorry.
Okay.
Add an extra zero.
Big numbers there.
Even more.
All right.
Jeez.
Thank you so much. And, you know, the other story that we didn't get to was Google making its biggest ever purchase, $32 billion in cash for Wiz, the cybersecurity startup. And it's coming back to do this, even though the FTC under Trump has kind of signaled that it's going to take a pretty close look at a lot of these deals.
You know what it'll do that? Extra premium, extra billions of dollars, right? Because wasn't it in like the 20 billions or so where they first came out and asked for the deal, and Wiz is like, nope, sorry, can't do it. Too much regulatory hurdles.
Yep.
But now when you're at 32 billion, that's a different kind of story.
That's worth my time.
That's worth the premium that we're going to see. Yeah, exactly.
All right, we've got more coming up on the close, including a look at the latest analyst calls. And we're going to take a look at what's happening with General Mills. This is Bloomberg. It's time now for our top calls and look at some of the big movers on the back of analyst recommendations. Let's start with Coinbase. Bernstein starting coverage of the crypto exchange platform with an outperform rating and a price target of $310. The analyst says Coinbase stands to gain from strong regulatory tailwinds from the Trump administration's promise to make America the crypto capital of the world. Shares currently down about 3.4%.
All right, Scar, I'm taking a look at Bloom Energy and Mizuho kicking off coverage with a neutral rating and a $28 price target. The analyst says that Bloom benefits from rapid demand for data center growth. However, any growth from artificial intelligence has already been priced into the stock's valuation. Those shares now down by about 2 percentage points.
And finally, Pepsi losing its overweight rating after Barclays cut the beverage and snack company to equal weight. The analyst says Pepsi's Frito-Lay North America business has suffered 6 sequential quarters of volume declines, and she tells investors to expect softer quarters ahead as macro pressures continue to weigh on the sector. You can see the shares down about 1 1/3%. And those are some of our top calls.
All right, Pepsi isn't the only consumer staples brand struggling to navigate macro pressures. Our next guest says the overall sentiment on the packaged food and snacking space is overwhelmingly pessimistic. And that's why investors will be looking at General Mills results out tomorrow for a better indication of what to expect from the sector this year. We're joined now by Nik Modi, Managing Director and Global Co-Head of Consumer Research at RBC Capital Markets. He has a sector perform rating on the shares. All right, General Mills, what are you looking for tomorrow?
Yeah, well, I'm looking for not such great news. I think we'll get kind of a confirmation that the environment is tough. Coming into the year, I think there was expectations and hope that things would improve. And it looks like things are actually getting worse. And, there's some real reasons why that's happening. Obviously, inflation continues to weigh on consumers. We have the added issues with all the headlines around job losses, especially at the federal level. And even if you're a private sector worker, your psychology and your consumer behavior is still being impacted with all this negative news that you're seeing out there. And then there's a very discrete issue with Hispanic consumers. We're seeing sentiment amongst Hispanics and activity amongst Hispanic consumers having dipped. And I think that's due to some of the immigration news and rhetoric that we've been hearing out of the administration.
So there's a lot to unpack with that. But part of it is obviously all those macro issues, which would probably affect most of the consumer staples, right? And then part of it is going to be General Mills. Like, do they have the right product mix at this time?
Well, I think that they've done a good job reshaping their portfolio. I mean, they've gotten bigger into the pet care category, which is a good category. Unfortunately, their brand, Blue Buffalo, has really been kind of squeezed in the middle, right? You have consumers trading down to discount value brands, those looking for affordability. And then you have, things at the higher end, like Fresh Pet, which General Mills really doesn't play in a meaningful way. So, they have some brand positioning problems. Long-term, being in the pet category is still a good place to be. And then on the other side of their business, look, I think they've done a good job innovating on their core, but I think they need to be a little bit more disruptive in terms of moving where consumers are moving, right? Having protein and Cheerios is important, right? I think that's an attribute consumers are looking for. But what about other protein-heavy snacks and food products that they can potentially get into? So I think there's a lot of opportunity for them. But it's tough to invest when the top line is under so much pressure.
Absolutely. So the plan to raise prices is probably, that runway has ended for now because consumers are so inflation conscious and price conscious overall. Is General Mills doing enough when it comes to mixing up the different volumes and package sizings that they can?
Yeah, I mean, I think I cover the entire consumer products landscape. I would say the packaged food sector in general is behind the household personal care, beauty, and the beverage industries, right? So I think, again, there's a lot of upside. But look, this takes time, right? You have to adjust your manufacturing footprint and your manufacturing facilities to make some of those smaller sized products that consumers might be looking for at the moment. So it's not like you can just snap your finger and all of a sudden you're pumping out a bunch of different pack sizes that consumers find more affordable, right? So I think that they're on the right track, but there's still a lot of wood to chop in terms of getting them where they need to be in terms of the scale of these product offerings.
Yeah, that's a good point. The other thing that has kind of been weighed over a lot of these companies is the fact that RFK Jr. is meeting with top executives, or he met with top executives from these major food companies this week. What kind of outcome do you expect from that? I mean, is this something that General Mills is likely to discuss or share on the call tomorrow?
I'm not expecting them to be explicit in terms of what came out of that meeting. I think there's probably going to be a lot of back and forth. But the one thing I would say is, look, I think we all know that certain attributes in some of these products, not having them might be beneficial to the consumer or to the actual health profile of that particular product. I think the issue has been that no one really wants to move first because you don't want to have a disadvantage versus your peer group. But if everyone has to, let's say, remove a certain dye from their product, then everyone's on the same footing, right? And I think that, is something that maybe investors need to think about, is that if we have a ubiquitous kind of and a uniform kind of application of what is out of the products, then I think these companies can reformulate and they all can do it together. And then there's no distinct advantage that one product might have over the other in terms of potential color of the product or the taste of the product. So I think if we see that, it won't be as impactful as many investors might think.
So taking all of that into account, what company in this space is doing things right that's worth investing in right now? Because as you pointed out, there are a ton of headwinds that don't seem to go anywhere anytime soon.
Well, listen, on the packaged food side, I think it's a tough call. There's not a lot of optimism, at least from my side. I've been pretty negative for the last year and a half. I don't really see a bottom at this point in terms of a fundamental bottom. There's no question that sentiment is as negative as I've seen it in 25 years of covering this industry, but the fundamentals still has some downside. My top ideas are all beverage related. I think there's a lot more opportunity and optionality that you have in the beverage space. My top idea, Primo Brands, and then I like Monster Energy, Keurig Dr. Pepper. So, there are things to buy. Packaged food, it's a tough place to invest right now.
So I guess you like the Ben Stiller's new potential drink, right? The low sugar Stiller that you can then potentially order. This would be like in your zone.
Perhaps.
Perhaps. All right, Nik, thanks a lot. Nik Modi over at RBC Capital Markets. We appreciate your time today. Scarlett, taking a look at the market here, we're off the lows of the session, but barely. I mean, the NASDAQ really underperforming. But if you take a look at the equal weighted index and the Russell and mid caps, they continue to outperform. They're still down, but nowhere near what we're seeing in the tech.
So it just goes back to that idea that people are rotating out of big cap tech into other parts of the market. Terrell Ho, one of our producers, points out that the S&P and NASDAQ are now headed for their worst month since December of 2022. That capped off the year of 2022 in which both the S&P and the NASDAQ declined by double digits, 19% for the S&P 500, and the NASDAQ was 33%. And of course, bonds also declined. So no protection that year at all.
You just memorized all those stats? You didn't look at your notes once. Yeah. No, but I didn't see you look once on
because
that.
The numbers are so big.
Oh, okay, fine. All right, well, coming up, we're going to talk about another underperforming stock, and that's Tesla, why investors are pegging EVs as the next big winner for artificial intelligence, but Tesla stock just cannot seem to get a bid. We're going to talk tech investing with Ross Gerber of Gerber Kawasaki next. This is the close on Bloomberg. Taking a look at the NASDAQ, still off by 1.7%, the S&P off by about 1 full percentage point. Taking a look at the bond market, a little bit mixed. You're seeing a little bit of buying, but honestly, not a lot of movement within the bond market, the action in tech. This is Bloomberg.
It is just about 3:30 p.m. in New York. This is the countdown to the close, and I'm Scarlett Fu.
And I'm Alex Steele. And we've had a whole half hour of television. We have not yet spoken about the Fed because that feels like, in some ways, a sidebar, because Jay Powell's goal will be to not make waves.
Yeah, Jay Powell's like, I can't believe I have to host a news conference and not answer any questions the entire time.
The interesting part, though, is the soft data has continued to come in and been really rolling over. And in the past, the Fed has looked at the University of Michigan, particularly the inflation expectations, and that has moved on tariff fear. So how do you get around that if you're the Fed?
Yeah, but you got to wait for the hard data, and you got to wait for some kind of pronouncement from the White House. That's what it all comes down to.
And in the meantime, tech continues to sell off. It's been a pretty feeble year so far for the Mag 7, many calling it now Lag 7. Meta
I like that.
Yeah, I know, right? Meta just became the last stock in the group to turn negative, but it's Tesla's performance that's really dragging down that index. Shares are down roughly 44% year to date. Joining us now for more on this is Ross Gerber, President, CEO, co-founder of Gerber Kawasaki Wealth Management and Investment Management. He invests in Tesla and currently owns 262,000 shares. Are you buying on the dip?
No, I'm not buying on the dip. Unfortunately, I wish I could tell you Tesla was cheap, but at 110 times earnings, it's still the most expensive stock of the Mag 7 and in the entire S&P by my standards of any large cap. So, this is the problem that Tesla has, is if you compare its valuation to companies like Nvidia or Microsoft, Tesla could go much lower than it is today, and that's what we're worried about.
Would you be selling then when we decline, or are you committed to this position?
Well, I don't like to talk too much about trading because my compliance people don't like it. But and that said, they're now blacking out us trading on the stock because I'm bringing it up. But that said, we've been sellers of Tesla over the quarter, and you'll see us have lower shares in our next filing.
I mean, Tesla's investor base is pretty varied. You have institutional investors, you have retail investors, then you have a lot of folks who just like Elon Musk. Are people rooting for Doge to hit a bit of a speed bump here so that Elon can then return to Tesla and steer the company back on course?
Well, I was just having this discussion with two of my great clients who are just massive Tesla lovers, and a huge amount of their assets they had put into Tesla early and made a lot of money and still have a ton of Tesla stock. And we were talking about this exact issue, which is if Elon came back to Tesla, that would be great. That's exactly what Tesla needs, but he's not. And he's going to stay at Dodge, and he's one of the most powerful people in the world now, and it's definitely gotten to his head. And I just don't see him changing and going back. I actually think he's completely neglecting Tesla at this point.
So that raises another interesting issue, which is, do they have a succession plan there? I'm not saying he's going to leave Tesla, but does he have people to mind the store while he's gone?
Well, this is exactly why I'm upset, because all the people that were minding the store from 2 years ago got fired. And there's a whole new team of people running Tesla at this critical period of time. And so he's made himself indispensable for Tesla. The team before, with Drew and Zach and Martin, they easily could have been running Tesla and doing a great job. And if anything, I think Elon should appoint a new CEO to run Tesla so that he can just focus on what he's doing in the government and also separate himself from Tesla, which is this great company that's trying to solve climate change, is now associated with Elon in such a negative fashion that it's destroying the sales of their main product, which is selling EVs. So, something's got to change, and I think it's going to happen this year.
Okay, Ross, so there's a couple things. One, obviously, is the Musk effect, and this time to the downside. And then the other is the overvaluation, which we talked about. But then the third is the actual sales in China, in the U.S., and in general. And we saw an RBC analyst lowering his price target today, saying lower estimates for the pricing of its, full self-driving technology, which is what was supposed to be a catalyst for that stock. How much of it's just fundamental?
Well, that's what I'm saying. I think a lot of it's fundamental. We can get into all the emotional reasons why Tesla isn't doing well, and then you can look at how these emotional reasons actually affect the actual sales and profits of the company, because it is now, and then how that extrapolates out into the valuation at 110 times earnings. Maybe at some point investors aren't going to give this huge premium based off all the potential of Elon Musk with robots and CADs and all this kind of stuff, and all of a sudden take this company back to earth. Because honestly, after watching the Nvidia presentation, you say, well, Nvidia is definitely the best company in the world, and so it trades at 40 times earnings today. I can buy Nvidia with 75% earnings growth at 40 times earnings. This is the cheapest of the Mag 7 or the big caps or the tech companies, and it's growing the fastest. So, it seems absurd that Tesla would have 2 to 3 times the valuation of Nvidia when there's so many things going wrong. And that's what we're worried about, that the fundamental story comes back to reality, and that could be very costly to current Tesla shareholders.
Yeah, no, sorry, we got confused on who was going to ask you the next question. So, Ross, I totally hear you on that. What would stabilize it, aside from us coming back? Fundamentally, what would stabilize it?
Well, the most important thing with any company is earnings and earnings growth and the certainty of that earnings growth. So certainly, if you want the stock to stabilize, you've got to have sales not continuing to go down. So sales and profits going down is definitely not going to stabilize the stock. So then you can ask yourself the question, how can we get Tesla sales to increase? Well, they have a new model out, they have a new truck out, they have the best products in their industry, the best software in their industry, the best products. Like, how can sales be going down? What should we do to rectify that situation? And why is it happening? And we know exactly why it's happening. And there are many solutions to rectify it. But Tesla isn't run by the board of directors. It's run by Elon Musk. And so it's just not going to happen.
Right. There's no urgency because he's not feeling particularly urgent about it.
He just doesn't care.
That's another way of putting it.
Well, he cared enough, though, for President Trump to buy a Tesla, so...
Yeah, does that matter, Ross?
He cared enough to get Trump to try to shill some Teslas, but I don't know if that helped at all, and then he didn't pick a Cybertruck. It's super lame.
Okay, so not only should he have gotten a red Tesla, but maybe a Cybertruck as well.
No, he should have picked the Cybertruck. Like, come on. Trump picks an old Model S. Guy doesn't even drive. And the other thing is, if you're going to do a sales event, at least get a guy who drives,
All right, all good points, and maybe it's something that they can consider for the next time around.
Well, I hope MAGA buys a lot of Teslas. They got to buy about 100,000 more Teslas this quarter to make the quarter.
All right, that's a good number. Go out and buy a car,
MAGA. Go out.
That's a good number to keep in mind. So, Ross, as you look at the Mag 7, and Alex started us off by saying that Meta is the last Mag 7 name to turn negative for the year. Which of the 7 names are worth buying right now on the dip?
Well, I did buy some Meta in my fund GK this week, and I just opened a position during the correction because Meta has come down to a much more reasonable valuation at 25 times forward earnings. And although their earnings growth isn't expected to grow much this year, I think that they've kind of guided down enough. And I think that, and I don't like Meta actually, but I've gotten to the point with their AI and what they're building and their domination and the position they have in the world is pretty dominant now, and their profits are really flowing. So we added at Meta, to the portfolio recently, and I think it's a good stock to own. Okay, so you can't help but like Meta in many ways then. Ross, thank you so much for joining us today. Ross Gerber of Gerber Kawasaki. Coming up, it is our stock of the hour. We're looking at shares of Abbott Labs. They are down after RFK Jr., the Secretary of the Health and Human Services Department, announced plans to meet with baby formula makers as part of Operation Stork Speed. Stock is down about 1% right now. This is The Close on Bloomberg. We're looking at shares of Abbott Labs down about 1%, and this comes on the news that Health and Human Services Secretary RFK Jr. is planning to meet with executives of U.S. infant formula companies to discuss nutritional standards and supply chain issues. This is according to Bloomberg reporting. So joining us now to discuss is Bloomberg's Madison Muller. Madison, can you tell us a little bit more about this? Because presumably this would be good news for consumers of baby formula and their moms. And the stock, however, is still down.
Yeah, so this follows meetings that RFK Jr. has had with food company CEOs and really fits within his Make America Healthy Again initiative to review ingredients that are used in the U.S. supply chain for food and for baby formula. And so we heard from sources that this meeting was happening today, and then HHS just came out with a statement saying that they are going to review the ingredients that are used in formula supplies. They're also going to test products for heavy metals like arsenic and lead, which is something that is done, but I think that the standards maybe are not where RFK Jr. would want them to be. And so this is something that, it could help. It could be a good thing. We all want healthy products for smallest kids and babies. So it's a matter of what this will look like in terms of policy, how it's going to affect the manufacturers, if it's going to lead to higher costs for them. Some of those things we still don't really know.
So for Abbott in particular, how much of their business is infant formula, and sort of what usually are their margins for this company, and how does that trickle through?
Yeah, Abbott still is a pretty diversified business. So they have infant formula, they have diagnostics, they have medical devices, and infant formula still is a big part of their business, or nutrition in general. They also make adult nutrition products. They make a protein shake for people on GLP-1 drugs, another hot topic. So it's still a big part of their business, but over the last few years, we've seen issues with contamination, recalls. There was a nationwide baby formula shortage in 2022 and into 2023. That was very bad. And so they've sort of dealt with some of this supply chain uncertainty, regulatory issues before. And I guess we'll see what ends up happening now. Yeah, Abbott makes Similac, and Reckitt Benckiser makes
Enfamil, which is the other big baby infant formula company. In terms of the big players in the market, is that it? Are these the two companies that we're really looking at here?
Yeah, it's Abbott, Reckitt, and Perrigo, which are the main three manufacturers of baby formula in the U.S. And some of this consolidation is why we saw such bad shortages after Abbott issued a recall back in 2022, is just because these are really the only big players. And we've since seen some smaller independent companies sort of step in to fill the gaps, but it is really still dominated by these three main companies. So that's sort of one of the issues that led to the shortages.
How soon do you think we'll get any guidance from HHS?
Yeah, I mean, that's another good question. I think that this administration is moving really quickly. So where their priorities lie, we're seeing a lot of action happening, and they're laying out these initial priorities after meeting with the baby formula manufacturers. And I guess we're still just going to wait for more details. But with the pace that this administration is moving at, we can probably expect to see some more soon.
All right, Madison, thank you so much. Really appreciate it. Bloomberg's Madison Miller joining us there. And speaking of looking at the market here, the S&P is now off by a little over 1%. The Nasdaq off by 1.7%. Scarlett, so off the lows of the session, but nonetheless, it looks like to be a relatively ugly close on this Tuesday.
It'll probably stay at these levels, given that we have the FOMC decision coming out tomorrow at 2 p.m. and we tend not to see a whole lot of movement in the last 24 hours before that happens.
And we make a lot of hay about, the correction that we saw within the S&P, but you could also make an argument, and some people do, that this is actually just a normal correction for tech because it was so overvalued and there was so much interest in it that it's just a normal re-rating for a sector that was really overhyped.
You mean things that don't just go straight up?
Apparently not, and maybe that's what we're seeing versus actually a fundamental correction. Anyway, we're going to take you to closing bells. Sinead Colton Grant, Chief Investment Officer at BNY Wealth, will be joining us 15 minutes away from the closing bell on this Tuesday. This is The Close on Bloomberg.
I think that stagflation light is how we have been characterizing our expectations for this year. Pricing pressure is not coming down. We're not seeing this immaculate disinflation. If anything, we're seeing some incremental pricing pressure because of tariff and policy uncertainty, and also just things that needed more time to kind of recalibrate themselves after the COVID and supply shocks and all of these things that have happened.
That was Winifred Cisar. She is Global Head of Strategy with Creditsights, kicking off the show. And Alex, this idea that just 4 weeks ago we had this strong economy and now people are talking about stagflation light. They're uttering the R word, recession. That comes up in conversation now.
Right, but again, it's still tech. That's like leading the way down, and particularly when it comes to today. So it's a Meta kind of rolling over now, erasing all its gains for this year, the last Mag 7 to do so. But you look at the equal weighted index and the Russell, and they're not as terrible. I mean, they're still holding in somewhat okay. So it really raises the question to me, is this actually a stagflationary trade in like fear, or is this just sort of a re-rating of some high flyers?
Yeah, a correction. A correction tends to happen, right? Down 10% from your highs. All right, so let's, with that in mind, move on and bring in our next guest here. She is Sinead Colton Grant, Chief Investment Officer at BNY Wealth. So, Sinead, if the stock market was priced for perfection at the end of 2024, and we've now fallen 10% since then, certainly for the S&P 500, more for the Mag 7 specifically, what is the stock market priced for now in 2025 in mid-March?
Look, it's a great question. And let's remember that we also had stronger earnings in 24. So some of the reason why we're seeing markets move a little lower is because some of that was pulled forward into 2024. There's a little bit more uncertainty in the macro environment. Markets are finding it somewhat challenging to grapple with tariffs. And frankly, we don't really have a framework yet. That's why April is going to be so important. If we have a framework on how tariffs will be applied and we can build from there, then I think you'll see markets turn a little bit more constructive.
What is the framework for now, though? Because assuming that we see more of what we have seen thus far, which is April 2nd comes and then whatever tariffs are going to take place get kicked down the road to maybe May 2nd or May 3rd. What do you do in the meantime when everything is in a holding pattern?
Well, look, you assess the probabilities. And for us, what that means is that this year, growth we think is going to be a little bit lower than we had thought a few months ago. So we've shaved off about 0.5% from the midpoint of our expectations. So we think it's going to be somewhere between 1.5 and 2% for the full year. At the same time, inflation a little bit higher, so a midpoint of 3%. Again, we're seeing prices a little bit stickier, but we also have to take into account the tariffs that have been put in place. So yes, I would agree there's an S word on the horizon, but it's slowing, not stagflation.
So if I take a look at what's done well so far this year within the S&P, healthcare and energy and utilities have done well. On the downside, it's really consumer discretionary and tech. How do you position then for the environment that you just laid out?
Well, look, tech tends to do well, or it tends to do badly when you have economic uncertainty, right? It tends to be over-indexed to economic growth. So not a surprise that you see it performing as it is. We like financials. We also like utilities. So with financials, they are benefiting from the rate curve. They're also benefiting from the potential for looser regulation, more M&A activity. And then with utilities, they're a very interesting sector. They have some bond-like qualities which help to diversify portfolios in times like this. But we also see that they've got long-term benefits with AI. We're hearing about demand for power from data centers. So there's a very nice uplift that you can get from the utility sector as well. But look, tech, consumer discretionary, when there are any questions about the health of the consumer, those are sectors, certainly discretionary, will be hit.
What we have seen, though, and this goes back to financials, is nothing's happening, right? Like M&A is really stuck, IPOs are stuck, like nothing seems to be moving because of the uncertainty. Does that wind up changing your outlook for financials? Because the good stuff just hasn't come yet.
So what we've been hearing from the administration is that tariffs are first, then we're going to talk about taxes and deregulation. And when you think about the previous Trump administration, it was the other way around. We got the tax cuts first, and then by the time that tariffs came around, there was a cushion. And so what we're expecting is that by the time we get into the second half, the picture is much clearer, and tariffs are in the rearview mirror to an extent. Yes, there's an impact on inflation, but then we're focused on how the economy is going to expand and grow.
And that's exactly what the Trump administration wants people to focus on as well. They've talked about how Trump doesn't really own the economy until 12 to 18 months in. We've seen money leaving U.S. stocks, and they're going outside the U.S. borders. They're going to European stocks, for instance, and that's contributing to dollar weakness and euro strength. Is this the start of a new trend, or is this just kind of a hiccup?
So we had some really surprising news from Germany, where they were going to exclude defense spending from their budget calculations. That's enormous. It's prompted a huge euphoria in terms of European stocks that we've seen since the start of the year. But there is a long way to go from that decision to actually implementation. And one of the big headwinds that Europe has had for quite some time is regulation, right? It's just hard to get things done. It's hard to build businesses. And that's what we need to see change as well. If you see that change too, that is very, very significant, but we're not there yet.
Okay, we're not there yet, but people are positioning as if this is the trade to go in on. It feels very much in the zeitgeist to talk about European defense stocks because everyone's piling into that. Talk a little bit about how headlines like Putin and President Trump's conversations helps drive that or doesn't drive that, because we're getting bits and pieces of news, trickling out day in and day out that doesn't really get us anywhere.
Well, so this afternoon we haven't really heard anything much about or anything material about that conversation between Trump and Putin. But here's what we do need to think about. If we assume that there is a peace agreement between Ukraine and Russia, then it is logical to assume that European countries will need to spend more on defense. And the big headwind that was pointed out in Draghi's report from 4 or 5 months ago is that European economies have been spending on defense, not enough. But the challenge has been that they've actually been spending outside the EU because they didn't have enough domestically located companies wherever they were in the EU. And that's part of what needs to change in order for Europe to really get the benefit of that increased defense spending.
Which, to your point, that takes time to ramp up the actual industrial base to do that. All right, Sinead, thanks a lot. We really appreciate it. Sinead Colton Grant, Chief Investment Officer at BNY Wealth. All right, we're just about a few minutes away from the closing bell, Scarlett. You're looking at the NASDAQ still around the lows of this session. Worst performing stocks, it's quite a mix. You get Norwegian, you get Royal Caribbean are down. They had that nice rally yesterday, though. Also, Super Micro getting hit. Tesla, of course, just cannot seem to find its footing. Yeah, Carnival Cruise will be reporting later this week, along with Nike. So we'll get a read on the consumer. But the retail sales number did indicate that things are slowing down. It's not terrible. It hasn't gone completely south, but it's very much an indication that things are moving in the direction of deterioration or at least a slowdown. Yeah, absolutely. All right, also taking a look at the VIX, a little bit higher here. Just hitting about 21, and the bond market not doing much of anything. Gold continuing to get a bid. We're moving closer to the closing bell. Full market coverage right here on Bloomberg.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
About 2 minutes away from the end of the trading day, Alex Steele and Scarlett Fu here to take you through the Closing Bell in a global simulcast. We're joined now by Carol Massar and Tim Stenovic, bringing together our Bloomberg Television, radio, and YouTube audiences worldwide to parse through the most crucial moments of the day. Carol, I swear we did have rallies when you were gone. You wouldn't know it, though, by looking at the market today.
What are you saying? I came back and I dragged down the market? No, it's kind of wild because I'm looking at what the Mag 7, all of them are down about 2.5%. So it really does feel like some malaise back in the market, but I will believe you that there were rallies.
Yeah, we had, well, even though the Mag 7 kind of sat out yesterday's rally. So that's what was pretty remarkable. It was a pretty broad-based rally yesterday, but we saw some of the mega cap tech names not actually take part.
And in fact, you have Meta now losing ground as well. So all the Mag 7 names are negative for 2025. I guess it wasn't that surprising in the end when Bank of America said that in its latest survey, investors have cut their holdings of U.S. stocks by the most on record. A big sea change.
Mm-hmm. Yeah, exactly. And the question is, does that continue, right? And what else does it entail? Does that mean we're going to sell treasuries? Are we also going to sell U.S. credit? Does that actually go elsewhere in the European market?
I'm going to head to Europe. That's exactly what I was going to say.
Are they going to like you there? I don't think they're going to like us anymore. I don't know if they like us very much.
This is a deep tease, but there's a new Air France cabin that you can fly, Carol. We're going to talk about that in a little bit.
We are going to talk about
Oh, okay. Well, I like that. That sounds nice and fancy. But you're taking a look here we're right near the closing bells here. S&P seems to be trading near the lows of the session, guys. The S&P around 1% lower. The NASDAQ off by 1.7%. So a little bit of steam to the downside as we head into the close. The Dow Jones Industrial Average off 0.6%. But I've been saying this all day, guys. It's really been tech-driven because you take a look at the equal-weighted index, for example. You take a look at small caps. Yes, they're still lower, but nowhere near what we're seeing within the tech sector. You have the equal-weighted index just off by 0.5%.
Yeah, really interesting in terms of perspective and context of what's really going on internally within the music and within the markets music. What am I hearing? Hey, the S&P 500, Scarlett, you do have, though, a majority of names lower in today's session, 338, losing some ground on this Tuesday. 161, though, did actually show up with some gains here.
Yeah, and take a look at the IMAP because there are two sectors that are in the green. Energy up about 0.25%, and healthcare gaining 0.1%. But as you mentioned, tech is really the laggard here, and whether it's communication services, which includes the internet service providers, along with Alphabet, consumer discretionary, which includes Tesla, or tech overall, which has NVIDIA, those groups are all down at least 1.5%.
All right, guys, let's get to some of the individual gainers. Atop my list is Intel, which is among your top gainers in both the S&P and the NASDAQ 100, or at least was earlier in the session. A gain of earlier in the day, about 2.8%, finishing the day with about a 1% gain. Stock really rallied nearly 7% yesterday. It's been up 5 sessions in a row, so it's up just around 30% over that time period. Our team noting that ahead of today, taking on his new role as CEO, Liputan sent a letter to employees warning that it won't be easy for the company to hold off the forces that have set into decline. Yesterday's Reuters saying that the CEO potentially plans to cut back on middle management. So we're keeping an eye on this one, but definitely a little bit higher in today's session. BYD, had to mention, at its highs up about 3.3%, closing with a gain of 2.6%. The ADRs in the United States, the Chinese automaker unveiled a lineup of electric vehicles that it says can charge almost as fast as it takes to refuel a regular car. So that's pretty impressive. And then Lucid Group, I know it's just about a $2 stock here, but still up almost 9%, up almost 16%, or more than 16% intraday. So really rallied earlier, but up about 9% here at the close. The EV maker upgraded to equal weight from underweight over at Morgan Stanley, which says it sees potential for the stock to re-rate with new leadership that can put forward an executable AI strategy through partnerships. So some analyst lingo there. Price target, though, unchanged at $3. Keep in mind, it's down about 19% year to date and down about 96% from its high back in February of 2021. And it's got a high short position as well.
Okay, you got the gainers, Carol. I was watching the decliners today, starting with NVIDIA down 3.4% today. This as Jensen Huang spoke at the company's GTC conference, which he referred to as the Super Bowl of AI. We got a lot of news today. NVIDIA unveiled plans for more powerful chips, an AI model for robotics, and personal AI supercomputers. And this event is just getting started. We watch this event closely for a few reasons, because we learn a lot about what NVIDIA's plans are for this year and next year, but also because it tends to move the company's stock. It's a different movement today, though, than what we saw over the past 2 years when GTC has gone on. The stock gained 0.7% on the first day in both 2024 and 2023. Gains extended to 4% and 5% respectively by the time the conference concluded later in the week. So stay tuned. We'll see what happens later in this week at NVIDIA GTC.
That was a very impressive summary of everything that happened in NVIDIA, because Alex and I were looking at the headlines earlier, and a lot of it was just like tech jargon that we totally didn't understand. There's something with Newton. There's a lot of complicated jargon in there.
There were words.
You're in good company. Lynn Duan came on our program during the 2 o'clock hour, and she was like, I don't even know what this means. So
good. Okay, great.
You're in good company. All you need to know is it's about physical AI. So we're going to have these robotic butlers.
Thank you. Okay,
doing
physical
all our work
AI.
for us. That's what I need. Hey, I think Scarlett, you mentioned, was it Scarlett or Alex who mentioned Meta Platforms today falling into negative territory for the year, down 3.7% on the day. It's become the last of the so-called Mag 7 stocks to go negative for the year, down 0.5% on the year so far. It's interesting because we saw earlier this year that record rally for Meta Platforms, unprecedented 20 straight sessions of gains. The stock climbed nearly 26% so far this year, but it's since erased all of those gains. And finally, Abbott Labs fell by 1% today. It makes Similac infant formula. It was down over 2%, but it bounced off its lows a little later in the session. This is we learned that HHS Secretary Robert F. Kennedy Jr. is planning to meet with execs of U.S. infant formula companies to discuss nutritional standards and supply chain issues. So we'll watch that one as well.
All right, got to be honest, guys, nothing happened in the bond market. There was a 20-year auction. It was solid, $13 billion. It was 20-year. Does anyone really care? Kind of going nowhere. Not a lot of volatility, not a lot of movement, which was surprising and interesting considering the sell-off that we saw in tech, but definitely a wait and see when it comes for the Fed tomorrow.
Yeah, exactly. It's like we're just kind of waiting, right, for that Fed decision or lack thereof, but at least what we get in terms of outlook. Hey, guys, in terms of what caught our attention, there is a redesign. Tim talked about this first-class cabin called Le Premier. It's from Air France.
Le Premier, of course.
I know, of course, right? It's supposed to be like a private jet-like experience. 3.5 square meters of private space, a full-length bed. You've got full curtains, and I think there's some nice wine. And I think it costs about, what is it, Tim, like $11,000 US?
Yeah, $10,000 or $11,000 for a
one-way trip. Round trip.
I think that's a one-way, actually.
Oh, 10,000 euros, excuse me.
A return flight to New York costs about 10,000 euro, and that's about 11,000 US. Compared with yeah.
But is this like in addition to the plane that has business class? Like, does this make business class cheaper? I'm just asking for a friend.
I think business class is not going to be as nice as this redesigned first class cabin.
Business class.
I mean, it's basically your own cabin here. There's
a
real bed that you can sleep in. It's pretty great. The executives who unveiled this, they talked about that they weren't seeing any sort of softness when it comes to the high end of spend, when it comes to the travel category. There's a quote in here. The CEO said, Paris is still the #1 destination people come to for many, many reasons. It's crazy what people are willing to spend.
Well, when the consumer is under pressure, you double down on the guy who can spend a lot of money.
100%.
I feel like I need to take on like 6 or 7 extra jobs to be able to afford that flight.
You do. This would be true.
So there's a story that caught my eye, which is about a Gen Xer who plans to earn $800,000 this year. Still probably not enough to be able to take that flight. By holding on to 6 remote jobs. How does he do that? He hires people to be him, basically. He'll make the decision, he'll show up on the conference call, but otherwise he hires other people to do a lot of the work.
Wait, so is $800,000 like net or gross?
I think that's gross, and he netted $320,000 in profit from this whole gig.
Couldn't he just get a job for $320,000?
So he takes on the job and then he hires people to do it. And so he's obviously going to pay them less.
He takes on several jobs, 6 jobs, and then he hires other people to do parts of those jobs. And that way he thinks it provides him job security, because if he gets let go from one of those companies, it's okay. He has 5 other jobs. So he's in good shape.
There's something very weird with this business model.
I would not want to be his accountant.
Yeah.
Sounds like
that's a good point.
Sounds like it could all come crashing down very, very
well, yeah,
quickly.
but like with like 4 of those companies saying, "Come back to work, get into the office," right?
Or like, what if they find out? Like, is that bad?
Yeah, that would be bad.
Okay.
Yeah,
is he identified in the story?
No.
Wait, Harrison?
Yeah, that's a pseudonym.
Harrison.
Yeah.
I know a Harrison.
Yeah.
I
know some Harrisons out there.
I know. I think we all know a Harrison. Probably not him. All right, guys. That's a wrap. Tuesday's over.
Harrison Ford.
You know what? I actually think he's
It's a Gen Xer. It's a Gen Xer.
There you go. Thank you. Good point.
All right. That's a wrap. Our cross-platform coverage, radio, TV, YouTube, Bloomberg Originals. We call it The Closing Bell. We'll see you again. Same time, same place tomorrow.
All right, and our thanks to our radio colleagues, and also our thanks to Alex Steele as well, who is going to take off. In the meantime, coming up on the rest of the close, how the defense sector is adjusting to the era of reduced government spending. A conversation with the CEO of Booz Allen Hamilton. This is the close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is the close.
Welcome back to the close. I'm Scarlett Fu. Let's take a look at the markets and where they closed out on the day as we take you beyond the bell. The S&P 500 losing ground more than 1% lower. Certainly not the lows of the session, but it's been a steady drumbeat lower through most of the trading session. All 7 names in the Mag 7 also finishing down, with Meta becoming the last of the cohort to erase its gains for the year. It is now in the red for 2025. Not much movement in the bond space. The 10-year yield inching lower by 1 basis point to 4.28%. And I included the ETF that tracks Germany. It is rising, extending gains from the regular trading session in Europe because lawmakers passed a landmark spending bill that will unlock hundreds of billions of euros in debt financing for defense and infrastructure. Certainly that has been a very popular trade. Defense companies in Europe getting a big boost on that. All right, let's take a look at some of the big movers on the day as well. Abbott Labs and Reckitt Benckiser. These are infant formula makers. RFK Jr. planning to meet with these companies to make some changes in their formula. We'll keep you posted on those developments. Abbott makes Similac and Reckitt makes Infamil. And Intel, interestingly, extending its rally to a 5th day, so defying the declines that we've seen in tech stocks overall. Lip-Bu Tan, that is, officially began his tenure as CEO. In his letter to employees, he warned that it will not be easy for the chipmaker to hold off the forces that sent it into decline. But he also did not really offer any clues on what his plan forward is, whether he would break it up and sell off parts or perhaps try to rework the company from inside. So watch this space in terms of what happens next on that front. All right, another stock I'm taking a look at is the government contractor Booz Allen, ticker is BAH. It is ramping up its AI investments and teaming up with Shield AI to deliver AI-powered autonomous solutions for the Pentagon. Joining us now with more on this is Horacio Rozanski. He is president and CEO of Booz Allen, which provides IT services for the government. Horacio, thank you so much for joining us today. Tell us a little bit more about this partnership with Shield AI. What does Shield AI do, and what is Booz Allen going to be doing?
Scarlett, it's good to see you. I'm here in D.C. And just for context, AI is the technology that is going to power both our economic security and our national security for at least the next 20 to 30 years. And Booz Allen is at the forefront of this. We are an advanced technology company providing some of the most important outcomes in AI to the federal government today. Shield AI is an amazing company. It's a relatively young company. And what they do is they're in the autonomy business. And the coolest thing that they do is they build, think of it as the operating system for drones. Mm-hmm. So in addition to the drones that they make, if somebody else wants to create a drone, they don't have to build all the software from scratch. They can start with what Shield does. And they're at a place where they're trying to scale their business. They've had tremendous success, almost more success than they can handle. Mm-hmm. And Booz Allen, we find ourselves as being an acceleration platform for companies like Shield AI, even larger companies. We also announced something with NVIDIA today. And what we do is we help them get to outcomes much faster. We help them create new engineering. In a case like Shield, yep. If you need to create new autonomous behaviors, almost think of it as apps on an app store, we would be creating those and making sure that their product can reach many, many more customers much faster.
All right. Well, thank you so much for explaining all of that, Horacio. When I look at your stock price, there's obviously been a lot of concern about the Trump administration's cost-cutting efforts. And your stock reflects that. It's down about 20% over the past year, compared with gains in the S&P 500 and in the S&P 500 Aerospace and Defense Group. Is this an overreaction on investors' parts to concerns about your government contracts?
I mean, I understand that the uncertainty creates a reaction. Having said that, Booz Allen is a technology company, and we're driving some of the most important outcomes that ultimately reduce waste, fraud, and abuse, increase efficiency, and will drive these technologies like AI, like quantum, like all of the technologies of the future. Our program with DoD has helped save over $16 billion in improper payments since inception. We have tremendous programs at places like Veterans Affairs that are vastly reducing the cost to process a veteran's claim. And again, on national security, we're accelerating our nation towards some of these outcomes by working with commercial companies that have unique technology that we can help adapt.
I understand all of that, but given the DoD budget cuts, what's the status of some of their existing contracts? For instance, the $245 million contract to support the Cyber Command's Joint Command Access Platform. There's a lot of analysts saying that perhaps you might need to make some adjustments to that kind of program. Is that something that is in the works?
What we see is near-term uncertainty and near-term disruption, but also tremendous medium and long-term opportunity. Areas like Golden Dome for America, the Space Defense Program. Booz Allen has some unique solutions we're offering there. Areas like Havana, where we believe we can bring additional technology to bear. So on the whole and on the main, we're optimistic about the future.
You generate almost all of your revenue from the public sector. Any plans to change that up and perhaps pursue more business in the private sector?
We did that deliberately because of our work in national security. We wanted to make sure that we were focused on what mattered most, which was to bring our warfighters home safe. But we do this with commercial companies already. So while our revenues come from the public sector, we work with private sector companies all the time. We are a private sector company ourselves, bringing that kind of dynamism into the market.
Sure. But still, there's a lot of uncertainty, and I just wonder how this is affecting your staffing or your plans for staffing. Is this something where you are freezing hiring? Are you cutting jobs right now? Are you shrinking your headcount, or just being more conservative about how you think about expanding?
At a time like this, we're running our business tightly. We're making sure that the people that we hire have the skill sets and the focus that is necessary to accelerate the missions that matter the most to the American people. We are very focused on these long-term opportunities. We're very focused on providing solutions to reduce improper payments across the federal government, not just in DoD, and to support the agenda of the administration. And so our staffing reflects all of that.
All right, Horacio Rozanski, CEO of Booz Allen Hamilton, joining us from Washington. Thank you so much. All right, coming up on The Close, Trump tariffs threatening to boost the costs of building materials. We're going to discuss with Paul Jannke. He is principal of Forrest Economic Advisors, which provides analysis on North American wood products next. Remember, lumber definitely in the crosshairs of those tariffs. This is Bloomberg.
Tomorrow, the Fed decides.
People just want clarity. Business leaders want clarity. Investors want clarity.
Trust Bloomberg to bring you the fastest coverage and exclusive analysis, including Powell's press conference.
What do they need to see to have confidence in the forward trajectory?
Could our big surprise be a growth slowdown?
What's worse than an economic slowdown? An economic slowdown the Federal Reserve can't respond to.
Tune in to Bloomberg Surveillance. The Fed decides, starting at 1:30 p.m. Eastern.
It's been 2 months since the LA wildfires destroyed more than 16,000 structures, and recovery efforts are quickly shifting to a costly and at times chaotic rebuilding. Slow permit approvals and labor shortages are clouding the rebuilding process of what is set to be the most expensive disaster in LA history. Joining us now to discuss is Bloomberg's Sarah McGregor. Sarah, thank you so much for joining us. Just give us a little more color here in terms of what stage the recovery is at now that we are a couple months out of the fires.
Yes, so almost sort of unbelievably, the cleanup has happened very quickly. We've been to Altadena, to Palisades, to some of the affected areas recently. Some properties have even been raked and sort of ready for a new house to be put on. Others, they're still sort of going through the ashes and the rubble. And so homeowners are really starting to think now, okay, what is the next step? And they're confronting a few different things. One is most people were not planning on rebuilding their homes. So they're having to come together and figure out with their neighbors, speaking with builders, like what does this rebuild look like? Two, people are trying to see what their insurance will pay out, because in most cases, insurance will not pay almost anywhere near where, the cost to rebuild. We heard one rebuilder say, for most of their clients, a rebuild might be $3 million, and they may get 1.7 million back from insurance, as just one example. So everyone's trying to figure out how much they can afford, how quickly they can move, and sort of come together with their neighbors to figure out what steps they can take together as a group.
So there's a lot of, pricing out different projects, I imagine. How are home builders and companies involved in that effort pitching themselves? Because clearly this is a massive, massive project, and it's one where they could, get a lot of business very quickly.
Yes. So, of course, there's custom builders, people who will be at the higher end. A lot of these communities, again, we're talking about multi-million-dollar homes. There might be people who might be able to afford that. But in many cases, middle-class people who are hoping to rebuild, are looking at builders who sort of have a menu of options. So maybe they have 5 floor plans. They can use economy of scales. They can sort of line up a few houses, sort of cookie cutter in a row on a street. But then that sort of taps into another issue for people. Do they want to have, a home that looks like potentially much like their neighbors, and how much can they keep the character of these neighborhoods? So again, that's another factor I think people are considering.
All right, Sarah McGregor, thank you so much. Sarah McGregor joining us from LA on the rebuilding effort taking place in that city. Can't get my words out. All right, joining us now for more is Paul Jannke. He is principal of Forrest Economic Advisors, which provides analysis on North American wood products. Paul comes with 30 years of experience studying the lumber markets. Paul, it's good to speak with you. As we focus on lumber here, I'm just curious how the rebuilding effort taking place across the greater LA region right now impacts the supply-demand picture for lumber. Is there a way to quantify just how much it's driving up demand, for instance?
Yeah, so it's really not going to be driving up demand all that much, because if you think about when you're going to rebuild in a particular area, you have supply constraints on the builder side. Builders can build a certain number of homes, and so if they have to rebuild their homes that they weren't otherwise going to be built, there are homes that they were otherwise going to be building that they can no longer build. So on the margin, you might have 10%. 15% slack on the builder side. I think that's really giving it quite a bit of leeway. I think it's probably less than that. So we're not seeing a tremendous increase in demand coming about because of the rebuilding. On top of that, as Sarah mentioned, some of these things are just going to take a really, really long time. You have the insurance issues. You have people dealing with how they want to rebuild their houses. So what we saw after the hurricanes in Louisiana and Texas and Florida was some of these homes, it took 5 to 10 years to completely rebuild. So there's not really a big increase immediately.
Gotcha. Okay, well then the more immediate threat, of course, is the 25% tariffs. How much lumber do we import right now, and how much will those tariffs reduce that in a meaningful way?
Yeah, so we import over, so in a market for the U.S. that's about 50 billion board feet, 50.5 billion board feet, we import about 12 billion board feet of lumber. So we import a fairly significant amount of lumber. Most of that comes from Canada. The rest of that comes from Europe. And from there, it's Germany and Sweden in particular. So it's a little under 3 billion board feet from Germany, Sweden, and the rest of Europe.
So how much do the higher lumber costs feed through to higher prices for newly constructed homes, for builders, and I guess at the end of the day for home buyers?
Yeah, so if we assume that the 25% tariff is fully passed through to home buyers, it really doesn't add that much to the cost of a home. So we're looking at about $3,700 increase. So if you're looking at lumber and panels, all of that's about $3,700 increase. So if you're looking at on a amortized over 30 years, you're looking at about $22 a month.
Okay.
So it's really not very much. So the price, and that's because the price of wood products, lumber and panels that you put up on the walls, they're just not that large of a component of building a home.
I see. So something you pointed out, which is that lumber production is not at full capacity because of labor constraints. Is this even before the crackdown on undocumented workers?
It is, yes. So we have, the labor is very difficult at a sawmill to find the labor to actually get these mills up and running to full capacity. And, this has been an issue in particular in the U.S. South, where we've seen a lot of expansion in lumber capacity over the past couple of years. It's been difficult to find the workers to operate these sawmills.
All right, good stuff. Thank you so much for joining us today, Paul. Paul Jannke is principal of Forrest Economic Advisors and an expert on all things lumber. All right, coming up on the close, the Fed decision is on deck. And so to help us prepare for that, let's bring in Betsey Stevenson. She is professor of public policy and economics at the University of Michigan. She joins us next. This is The Close on Bloomberg.
I think in the near term, the Fed's going to basically be on hold, waiting for more information.
If we're right, and inflation is going to surprise on the low side of expectations, we wouldn't be surprised to see 2 or 3 cuts.
Right now, I think they're probably going to keep the 2 cuts and kind of see how this plays out. Ultimately, they'll probably be, forced to cut a little bit more than, what's in the dots.
We do have a lot of uncertainties going forward, and I think that's the problem for the Fed. Looking at these numbers here, as Powell has already said in his recent speech, it's all about trying to extract the signal from the noise and trying to account for some of the uncertainties that are ahead.
And those were just some of the experts weighing in on the Fed's path forward before tomorrow's rate decision at 2 p.m. Eastern Time. Joining us now to give us her take is Betsey Stevenson, professor of public policy and economics for the Ford School at the University of Michigan. She was also the former chief economist at the Labor Department under President Obama. Professor Stevenson, always great to see you. Thanks for joining us today. The White House has made really clear that the tariffs, the on-off tariffs, the constant threats may boost inflation expectations, may roil the markets for a while, but they see it as something transitory. How do you think the Fed is going to take that into consideration?
Well, that's a funny word to use in asking about the Fed, right? The Fed doesn't have a lot of patience for transitory anymore. So I think you can burn them once, but we're not going to burn them a second time. I also think that it's really unclear how long it takes to play out the goals of the Trump administration, sort of economic restructuring. And, it could take a very, very long time. People don't just build factories overnight. They take many, many years. So I think the Fed's just going to be looking at the numbers and seeing, are prices coming down or going up? And are people getting jobs or losing jobs?
Okay, so let's go to the job side of the equation there, because that is your specialty. And I wanted to ask you about how you noticed in your research that people are actively searching for another job while employed. And that's actually something that you've seen pick up recently. What does that tell us, or what kind of signal does that send?
So, I think it is worth just pausing on the fact that the U.S. is a very dynamic labor market. So every month we see 5 to 6 million people who leave jobs and who start new jobs. So it's a massive amount of change, and that is very healthy, very good. We like to see that. So who's looking for a job is normally people who already have a job. And there are 2 reasons you could be looking for a job if you already have a job. Reason number 1, you want a better job with a great opportunity. Reason number 2, you think you're about to get laid off. So with reason number 1, you're looking for something that's a big improvement. And that's why, if you go back, a year ago, the people who were changing jobs were getting huge wage gains compared to the people who were not changing jobs. And that was pretty much the pattern we saw in 2022, 2023, 2024. We just saw something really unusual, which is the people changing jobs are getting smaller wage gains than the people leaving jobs than the people staying in their old job.
I see.
That's unusual because you're changing a job to get something smaller than what the typical person's getting if they don't change. So what does that tell us? That tells us that the people who are getting these new jobs now, they're doing it probably because they're trying to avoid getting laid off. It may also be that these are some of the people who were told, come back to the office or find a new job. And we know from the research that people are willing to take a lower salary to get flexibility.
But all things being equal, it could also signal that the labor market is softening a bit here. So on the labor market side, that's something to keep in mind. When it comes to the slowdown in the economy overall, there's been some disappointing survey data. You can look at ISM Manufacturing, you can look at Empire Manufacturing, which was a big negative. But in terms of the hard data, that hasn't come through. How do you think through what the lag time is before that softness makes its way to the hard data?
Right. So that's one of the reasons to look for something as subtle as the fact that it looks like a much larger share of people changing jobs are doing it because they're forced to leave their old job, or they see the writing on the wall that they're going to lose that job, rather than like fresh opportunities, because that's a very, very leading indicator. That's what people are doing on the ground. We can also see that if we see consumption spending start to pull back, those are the kinds of leading indicators we want to look for. By the time the unemployment rate really starts going up, that's game over. Like, we're already in a pretty big slowdown. And particularly coming out of a period of time where businesses lost a lot of employees due to the pandemic. It was very hard to get them all back. I think we're going to see reluctance in laying people off until they have to. And when they have to, that's going to be a time where we're already in the recession. So if you see it in the labor market data, in the actual hiring and unemployment rates, we're already there. We're already in that time.
So that's the caution with, or something we need to keep in mind if the Fed's going to be so data dependent. One thing I'm curious about is whether, or to what extent, there will be questioning of Jay Powell when it comes to the new Fed vice chair for supervision, because President Trump has nominated Michelle Bowman as his vice chair for supervision, who oversees the financial sector. Michael Barr, of course, stepping down from that role once Trump was elected. How do you see this playing out? Because she's known to be definitely much more, I would say, lenient on regulation for the financial sector.
Well, I think it's worth keeping in mind that as the vice chair, what her job is to do is to propose policies, to bring an agenda, but you still got to get the board's approval. So it's not, you don't become the king or queen of bank supervision. You become the person who's driving the policy agenda. She's been on the board for quite some time. It's kind of seemed obvious that would be President Trump's pick. She does seem to be a bit more lenient, but the hope is she also understands that if we're going to give guarantees to banks, that we're going to bail them out if they take a risky bet and they lose everybody's money. Well, then we have to have some rules in place that constrain that riskiness. All insurance leads to more of the bad insured thing happening unless you put some safeguards in place to try to undo that incentive. You go to Michelle Bowman, the bank she ran was part of her family. And right on the very front page, it says, "Don't worry, backed by the full faith and credit of the U.S. government." I'm glad that the money in that bank is backed by the full faith of the U.S. government. But if I, as a citizen, am back in the bank, I want to make sure that the bank isn't taking on extra risk, because, with that, it's heads, the bank wins, tails, me, the taxpayer loses. And that's why we need some supervision.
Fair enough. Before I let you go, Professor Stevenson, I know that we're not expecting a whole lot of breaking news announcements from Jay Powell at tomorrow's news conference. He wants to kind of keep news as quiet as possible, given that there's so much uncertainty. But what do you think we're likely to get when it comes to that dot plot, the projections from the Federal Reserve on inflation or on unemployment or on GDP?
I think what we're going, first of all, I don't think anybody's expecting them to change where the rates are currently. And I think they're going to have to take a wait and see approach. If you look around at different forecasters, we've seen forecasts for the U.S. growth lowered for 2025. You might see a little bit of incorporating that concern about a potential slowdown. You might see a little bit of a slowdown in the expectation of when we get rates down, given the data that we've seen so far. But I think that's obviously what we're waiting to see is where are all the governors on this? Where do they think, now that they know what they know, are they willing to make some changes? Given how much uncertainty there is, I wouldn't be surprised if we didn't see much, though.
All right. Betsey Stevenson, thank you so much for joining us today. Professor of Public Policy and Economics for the Ford School at the University of Michigan. Clearly, as we've been talking about, the Fed worries about employment as well as inflation. And on the inflation front, earlier this year, eggs have really become synonymous with that trend. Higher prices triggered by the bird flu led consumers to find substitutions. Stepping in to fill that gap, Just Egg's plant-based egg. The backdrop of rising egg prices and bird flu concerns have caused Just Egg to grow 5 times faster this past month compared to the same period last year. Joining us now to discuss is the co-founder and CEO of Eat Just, Josh Tetrick. Thank you so much for joining us today, Josh.
Good to be here.
Talk a little bit about how demand ramped up in recent months as we saw a dozen eggs climb in price to, oftentimes $15 a dozen.
Well, we're up 5 times what we were at this point last year. And importantly, the vast majority of people that are buying Just Egg are not vegan or vegetarian. So it's been a ride. So far, so good.
So far, so good. Now that egg prices have started falling, at least so far in March, and hopefully that remains the case for those who really rely on it, what does demand look like? Have you been able to hold on to those customers?
We have about 56% of the people that purchase Just Egg end up buying it again. We're going 5 times faster than chicken eggs are. We're in about 40,000 points of distribution, Walmart, Whole Foods, Safeway. When people are buying it, they tend to buy it again. And thankfully, the vast majority of people, they're not plant-based. These are folks who might have organic beef in their grocery cart. They might have oat milk, and they might have Just Egg. When you ask them, why are you buying this egg from plants? What they end up saying is, I'm trying to eat a little bit healthier. I like a good tasting omelet. I like some tasty French toast. But I'm trying to eat a little bit healthier. And that's where we're seeing on the growth. So we do tens of millions in sales. Velocity is up across the board. And this is really the most unique moment in our company's history up to this point. And I think maybe the most unique moment for any plant-based product, because often on the shelves, the only egg that you will see is an egg from a plant that happens to be made by us.
Can you talk a little bit about demand from consumers versus institutions? And by that, I mean, hospitals, for instance, or cafeterias or nursing homes, those big bulk buyers.
Yeah, so we have certainly big demand from all the retailers, but we're in hundreds of colleges and universities today, hospitals, stadiums. Just in the last month and a half, we've had some of the largest convenience store chains reach out to us. Some of the largest fast food chains reach out to us. We've had the U.S. military reach out to us. We've had a big biscuit chain in South Carolina reach out to us. So we're seeing that same kind of growth on the food service side, as well as the retail side.
So when it comes to how you plan to move forward, I mean, the goal here obviously is to retain a lot of these customers, even as egg prices start to come back down to earth. What kind of plans do you have on improving on the formula or perhaps building out different options for your customers?
So just to give your viewers a sense of how we make this, we found this bean called the mung bean, and there's a protein in it that we remove at scale in a facility in western Minnesota, this little town called Appleton. And every year we make it better. So every year we improve the texture, the flavor, the bite. Every year we want consumers to make a slightly better omelet than the year previous. So in June, we're coming out with version 6 of the product. So it's a better bite, better texture, fluffier. I feel like if I made the omelet in front of you next to a chicken egg, you might not be able to tell the difference. But what we really want is a few years in the future to have a chicken egg omelet and have our omelet, And not that you can't tell the difference. We want you to say, I like this one better. And we want to ultimately be lower cost. And ultimately, we don't just want to be the most reliable egg, but we want to be the lowest cost. We want to continue to be the healthiest, and we want to be the best tasting egg. And if we can do that, watch out.
All right, Josh Tetrick, co-founder and CEO of Eat Just, joining us here on their egg alternative product. Thank you so much. Let's just give you a recap here of what happened in trading today. We have the S&P 500 resuming its sell-off from last week. We did have 2 days of gains, but as you can see, down more than 1% on a day, and really driven by the big tech names. Meta became the last of the Mag 7 names to erase its gains for the year, and the group as a whole dropped 2.5%. Not much movement in the bond market as investors await the Fed decision tomorrow at 2 p.m. and the news conference at 2:30 p.m. The 10-year yield coming in at 4.28%, just lower by 1 basis point. German stocks continue to keep an eye on that one after lawmakers passed that big spending package that will unlock a lot of money, hundreds of billions of euros for defense and infrastructure spending. This is The Close on Bloomberg. It's time now for the top three, where we name drop the people driving some of the day's most talked about stories. And first up is Vladimir Putin, the Russian leader speaking with President Trump for more than 90 minutes today on the telephone, agreeing to limit Russian attacks on Ukrainian energy assets. Putin did stop short of agreeing to a broader 30-day ceasefire, so more discussions are likely needed. Next up is Jeffrey Starks. The FCC commissioner says he is stepping down, and this move comes as the senior Democrat has clashed with the current FCC chairman, Brendan Carr, over issues. And third on the docket is Novak Djokovic. A players group co-founded by the tennis star is suing the ATP and WTA tours over pay, alleging that they run a cartel that caps prize money, limits off-court earnings, and restricts competition from rival tournaments. Now, we're going to stick with sports because another story that I'm keeping an eye on today involves the San Francisco Giants, the baseball team. MLB, or the MLB team, I should say, has sold a 10% stake to Sixth Street Partners, the investment firm. It's one of the latest indicators of sports and private equity converging. Joining us now with more is Randall Williams. He is Bloomberg News' U.S. sports business reporter. And Randall, we talk a lot about the NFL welcoming private equity into its ranks, but now you have an MLB team doing the same. Was this a surprise?
Not necessarily. I mean, baseball welcomed private equity years ago. They have some of the more aggressive rules, allowing up to 30%. A single fund can own 15% of a franchise. So it's not necessarily a surprise. My editor, Giles Turner, reported that they were considering selling a stake. Sixth Street has been one of the more active private equity firms in sports. So they found the right fit. They're going to fund some real estate developments, and we'll see where it goes from there.
And what is the rest of Sixth Street's portfolio? Because like you said, they've been pretty active, and I think they're one of the PE firms that's allowed to invest in NFL teams.
Yes, they also own a stake in the San Antonio Spurs, Real Madrid, FC Barcelona, and I believe Bay FC, I believe it is, or FC Bay Area.
I guess it kind of makes sense for a team like the Giants to bring in private equity, given that it's a hotbed for venture capital and for, all kinds of financial deals, as opposed to maybe some other teams. Let's talk about another story, and this also takes place in a big sports city, and that is the LA Dodgers star, Mookie Betts.
For sure.
You spoke with him recently, and obviously a huge name in LA, a huge name in Boston, where he used to play, and in baseball overall. But he is trying to make a name for himself in another sport.
Yes, he's buying into a bowling league. There's not much details out there about the bowling league, but he's going to own a team. We'll have to see how the team does. He's also somehow bowled a 300 perfect game in bowling.
300 is a perfect score?
It is. So he's incredible. I mean, I think we're seeing this era of athlete investments, and I don't know that baseball players have been as active just because their contracts are so long. You see 300, 400, and even $700 million deals, but it takes place over the course of a decade. So whereas an NBA contract is 5 years, $300 million, in baseball contract it's 7 years, $700 million. And so for Mookie, he's in the middle of a $300 million deal himself. Mm-hmm. We'll see him make business investments like this one in years to come.
Is there a professional bowling league?
There is, but this is a new one, a new upstart league that I would say. I asked them what was the funding behind it, how much he paid. They declined to comment. So
so no details really as of yet, but Mookie Betts making a big splash in the bowling. I don't want to say industry, but
universe.
Bowling lane. Yeah, bowling lane. How about that? The other thing I want to ask you about is, of course, the start of the MLB season. Spring feels like it's just around the corner, and the league is going to kick things off in Tokyo, which is kind of a big deal given how many stars they have from that country, from Japan, playing in different teams, especially in LA.
Of course.
And it's part of that effort to really attract fans outside of the U.S., particularly in Asia.
Yeah, all sports leagues are trying to find a huge second market, and baseball has found theirs in Japan. I mean, if you remember for the latest World Series last year, 15.2 million viewers watched Game 1 and Game 2, and I'm sure for the MLB, they're looking at that market, and which is driven by Shohei Ohtani, of course, and saying, like, we have to capitalize on that. And so you see these games being played. You're going to see a lot of people from the U.S. travel to Japan. It's during the tourism season where you can catch the cherry blossom trees and everything like that. So Shohei Ohtani is driving a lot of popularity, and we're seeing that with these games.
And a lot of Japanese players are now coming over to the U.S. because of how much more money they can make in the MLB versus the Japanese professional leagues as well. I mean, Shohei Ohtani's latest contract being the shining example.
Absolutely. I mean, even if you don't get a Shohei Ohtani-like contract, getting $20 million, $10 million, $30 million is life-changing for these players. And it's the exact same thing when you look at the NBA and players who are playing in Europe and want to come over and play. The MLB is now seeing that, where they're attracting Japanese players, and if they can do that by having some of these players watch these games in Japan, and then, you try out, you meet people, and you network the same way that we do in our jobs, and hopefully you can end up with a roster spot and work your way up to a $100 million deal someday.
But we haven't gotten to the point yet where you have players coming straight over and starting their professional career in the U.S., right? I mean, they're still coming from the Japanese pro leagues. For sure. That's still what's happening for the most part, and I think we'll continue to see that. The pipeline is still, I wouldn't say fractured, but it takes some time to develop when you're going from an ocean across and trying to see, because you still have domestic prospects, and baseball is always going to be an American sport, and while it has a global presence, it's based in America. So these baseball teams will look here first and then look elsewhere. All right, great stuff. Randall Williams, Bloomberg News' U.S. Business of Sports reporter, and a reminder, because of course we cover all kinds of different sports here, and that includes college basketball. You'll be following that one, right? Of course. Okay, and don't forget to participate in this year's bracket for a cause for March Madness. And you can do so by typing in BRKT into your terminal and clicking on the Make Your Picks function. Randall Williams, thanks again. Thank you. All right, still ahead, what investors need to watch for over the next 24 hours. This is Bloomberg. All right, let's look ahead to what else we're watching for over the next 24 hours. And of course, we start with earnings. It is the tail end of earnings season, but nevertheless, we'll be hearing from General Mills, Williams-Sonoma, and Five Below. So definitely a read on the consumer. And then the BOJ also makes its decision, its announcement. It's expected to keep rates on hold after raising rates in January. And of course, at 2 p.m., the Fed decision, followed by Jay Powell and his news conference at 2:30 p.m. This is Bloomberg.